Hello, I'm Electra Frost, and this is Accountants on Chain with Julian Cheng from Gilbert and Tobin, partner in tax. And we're at Digital Playhouse. This is an Accountants on Chain session, and you might have been to some of them before. We often look at technology, but today we're going to get deep into the tax, legal and structuring issues. Can everyone hear me okay? Okay, I'll ask now that people are just coming in now, so I'll ask that you mute yourselves, and we are recording at the moment, so just mute yourself please, and yeah, hide your video unless you want to be on the recording. Okay, so we'll be recording this session, and slides and an article will follow with the recording afterwards. Okay, now just a bit about Digital Playhouse before we introduce Julian. So you may know about us. We're a not-for-profit registered charity in Queensland, helping with digital skills improvement in regional Queensland. Financial literacy and inclusion goes hand in hand. So we are a public benevolent institution advancing social and public welfare through education. And yeah, some of our projects are you know, we have the School of Bitcoin and Stacks Australia. You can check those out on our website. And we also have Accountants on Chain, because School of Bitcoin is all about learning, Stacks Australia is all about building, and Accountants on Chain, which includes bookkeepers and advisors, people in the financial, they're about support, and lawyers too. So, you know, maybe I should have called it Advisors on Chain. I'm thinking about it. Thank you very much to those of you who donated when you booked your session. Those donations literally fund our centre, so they're much appreciated. Okay, and just check out our projects if you'd like to learn more. What we have to say, if I said it, I didn't say it. So this is all general advice. It's to help you get thinking and come to the right conclusions when you're, or at least to understand what you're dealing with when a client comes to talk to you about these issues. You'll have some familiarity, but it's not advice. Although, you know, you may be able to reach out to Julian to assist you with complex matters, and he'll explain that himself. Okay, I will stop sharing at this point.
I'll share my screen.
Yeah, so yeah, just show us your, now everyone, this is Julian. I'm going to introduce him to you, but he wants to show his screen first. Can you show us the previous one? Excellent. So cryptocurrencies, digital assets, key tax considerations. So now, yeah, before we carry on, just questions submitted in the booking form. They'll be raised at the appropriate point or covered in the materials that Julian's going to go through, and we'll also take some breaks through the session to answer questions at the right time. So yeah, Julian, tell us a bit about what you do at Gilbert and Tobin.
Yeah, great. Thanks, Electra. I've sort of been working in tax for over 25 years at various firms, and Gilbert and Tobin for the last 2.5 years or so. And I guess I focus on a range of tax matters, typically in mergers and acquisitions, corporate restructures, tax audits and reviews, and cryptocurrencies, and another area which has been, I guess, a more recent area of focus. Sort of got into that space because Gilbert and Tobin has a fintech kind of blockchain practice, and we were getting a lot of queries from clients, founders of projects. You know, what are the issues? How sort of token raisers treated? What are the CGT kind of issues we need to be aware of? And so basically thought it would be good for myself, for my own benefit, just to get a bit of experience in the space. So set up an account with an exchange probably about a year ago, invested in a few kind of tokens just to see how it all worked, and did a fair bit of research in the space in terms of regulatory developments in other jurisdictions and Australia. So that's sort of how I kind of got involved in this crypto and digital asset space insofar as it relates to tax.
Okay, and has it made you more curious, or are you just keeping up with what your clients doing? Because that sounds
it's definitely made me more curious, and sort of the issues that I'm curious about sort of vary depending on how well the market's going. So obviously, when I gave a similar presentation in November last year, a lot of the questions we were getting from clients were, well, are our gains on capital a revenue account? Can we claim the 50% CGT discount when we sell tokens? And now it's all about, can we deduct our losses? So it's, but there's always something new happening in the space, whether it's treatment of DAOs, which we'll cover off on the presentation, treatment of token raises, which is obviously a key issue for founders, how to set up projects, what's the ideal structure. So there's always something interesting happening in the space. And so, yeah, I'd have to say that, yeah, it's my curiosity hasn't sort of dulled over the...
It does require some curiosity. Can you show us your agenda for today?
Sure. So after
to look ahead,
brief intro, going to cover off on some recent regulatory developments, and most of you will probably be aware it's moving quite quickly in this space in terms of regulation. Recent ATO guidance on a range of different issues relevant to how founders of projects and cryptocurrency itself is taxed. Some structuring considerations, again, around sort of setting up DeFi projects, how DAOs are treated, how providers of services to the crypto industry are typically set up. And then we'll finish off with some other issues, looking at kind of treatment of losses resulting from scams, theft. We'll get quite a few sort of queries on that, and how to potentially remunerate employees by way of tokens and cryptocurrencies, and then finish off with some closing comments.
Fantastic. And again, we're covering a lot here. So if you need to ask a question, just put it in the chat box and I'll raise it to as we go along. Okay, Julian, please take it away. There's been a lot happening in the regulatory space for us to keep up with.
There has been, and some of you would have seen that Senator Bragg released a private bill into sort of yesterday on regulation of various regulatory issues relating to digital assets. But I guess before that, it might be useful to just look at some of the headline articles. I mean, in August last year, it was kind of sort of about the crypto bubble drawing in quite a few investors, as you can kind of see. And then there was a lot of movement around Bitcoin hitting kind of a record high, almost US $69,000 in November last year. Use of tokens to make payments, so paying for petrol and other goods and services. And that's sort of something that's been received quite a bit of press and attention over the last few years. And then we saw sort of 1.9 trillion wiped off the market as cryptocurrency prices fell, and that was earlier this year. And so there's been, I guess, quite a bit of talk of institutional investors now moving into that crypto space, investing in cryptocurrencies, and funds being set up to help retail and wholesale investors invest in cryptocurrency. And I suppose with cryptocurrency going mainstream, there certainly has been scrutiny by the ATO, and we've definitely seen a lot of press releases, media releases come out of the ATO, just warning taxpayers that they really need to account for their cryptocurrency correctly from a tax perspective. So hoping to kind of take everyone through what they practically need to think about in that regard. The other one there, the one on the article on the left is quite interesting. So you can stake your cryptocurrencies and essentially earn cryptocurrencies. It's almost like putting money in the bank and earning interest. And the issue that the ATO was raising is that when you receive tokens from staking your tokens, then you're assessable on the market value of those tokens at that time. So let's just say you received 10 tokens and each one was worth $100. So you need to include sort of $1,000 in your assessable income. But that token may then fall in value. Obviously the pricing of these tokens can be quite volatile. So at year end, it might only be worth $20, even though it was $100 when you received it. And sort of the ATO is kind of saying, well, notwithstanding the decrease in the price of that token, you still need to recognize the income based on its value at the time you received it. So,
well, they've only got the current law to go on, haven't they?
Well, that's right. So that's just, and certainly that's what the current law would provide in terms of, like, if you receive dividends, almost like receiving dividends in the form of shares, dividend reinvestment plans, you're assessed on the value of those shares at the time you receive them. The same goes for tokens from staking, received from staking.
So there might be a few people here who have been the bearers of bad news to their clients in that area. And knowing a bit more about the whole crypto space does make you feel more confident dealing with clients.
Yeah. And then certainly, sort of as reported in May, the ATO says more than 300,000 people have invested in digital coins for the first time this financial year. And so the ATO actually has links with a lot of the exchanges, so it's able to track the trading activity of Australian taxpayers. So I know they have been sending out letters to tax agents and directly to taxpayers saying, if you've traded crypto, please make sure that your tax return properly reflects all of those transactions. So I guess, what are we seeing in the market? And I've touched on some of these already: structuring issues for projects, a lot of regulatory developments, ATO review and activity, as I just mentioned, the establishment of DAOs, and then that kind of ties in with the structuring issues kind of element of this presentation. Treatment of losses, are they deductible or are they on capital or revenue account? Remunerating employees, and then kind of issues for investors and traders. So I'll be covering off on all of those today. So just very briefly on the regulatory side of things, you can see from this slide here that there's really four main regulators. There's kind of AUSTRAC, which obviously directed at, or whose aim is to prevent money laundering and financing of terrorism. So there's certain, obviously digital currencies and crypto can facilitate that type of financing and tax evasion. So there are certain transactions that need to be reported to AUSTRAC there. ASIC, obviously, in terms of protecting retail investors, the chairman recently stated that there was a desperate need for retail investors, for protection of retail investors, because they don't understand that cryptocurrencies are currently unregulated and very volatile. And then you've got sort of Treasury undertaking a consultation on licensing and custody requirements for crypto asset secondary service providers. And on the taxation side of things, the Board of Tax is currently undertaking a review, a consultation paper. Submissions are due at the end of this month on review of the tax treatment of digital assets and transactions. And a lot of these developments came out of a review by the Senate Select Committee on Australia as a Technology and Financial Centre a couple of years ago, where they established or recommended a token mapping exercise be undertaken. They also recommended that a new decentralised autonomous organisation company structure be set up. They recommended amendments to the CGT rules so that you only have a CGT event where there's a clearly definable capital gain or loss. So a number of changes are expected to happen, I guess, on the regulatory front. And I guess just to expand or look into some of those in further detail, token mapping, there was a joint media release, I think about a month ago, whereby the Treasurer announced that Treasury is going to prioritise this token mapping. And I guess, what does that mean? Obviously, tokens have different features. Some of them provide governance or voting rights. Some of them can be used to make payments for goods or services. Some are more akin to like shares and that kind of thing. And the thinking is that tokens with different features should be treated in different ways from a regulatory perspective. And to I guess, to develop that regulatory framework, there needs to be a map almost drawn up of the different types of tokens out there, which can then form the basis for what sorts of regulations are needed for particular types of tokens. And look, there's been a number of attempts made to kind of categorize tokens, and certainly the OECD's three categories look at sort of payment tokens, which are more akin to fiat, like Aussie dollars or US dollars. You can use them to make payment for goods and services. Then you've got kind of security tokens, which are designed to be more tradable and held for investment purposes, more akin to like a security or a share. And then there's utility tokens that can facilitate access to particular goods or services. So they might confer a license allowing the holder to access a particular service. So that's what's currently underway. There's going to be a kind of a token mapping exercise as a starting point to determine what regulations are required in respect of different tokens.
Julian, we did have a question just on the topic of staking coins. So people who lost their investments in the Celsius platform with its bankruptcy, out of this regulation, is there any talk for solace for investors who've had their coins locked in the fund?
There's a slide that I'll be talking to later on about whether you can deduct losses from exchanges going under or scams or theft. So I might kind of defer it until that slide, but yeah, it does extensively go through the avenues for relief.
Thank you.
So on the Board of Taxation side of things, as I said, they're undertaking a review that's going to look at, without going through all the text on this slide, kind of the current Australian tax treatment of digital assets, how digital assets and crypto are taxed in comparative jurisdictions. And then kind of the upshot of all of that is going to be whether or not changes to Australia's tax laws and all their administration are warranted, having regard to, I guess, the submissions received by the Board of Tax. So that's kind of where we're currently at. This consultation is scheduled to complete by the end of this year. And there's really three key elements when you distill what the Board of Tax is looking at. They're sort of saying, well, where to tax? What are the taxing rights in a country where entities transact using crypto assets? What to tax? I mean, what kind of profit should be taxable? What losses are deductible with respect to those crypto assets? And then the last element is when to tax. What sorts of transactions involving crypto assets should trigger a taxing point. And I'm going to be going through those taxing points, at least under the current Australian tax law, in more detail shortly. So as a starting position, you kind of look at cryptocurrency and you've got to go through the same analysis as you would with any investment, whether it be shares, or putting interest, lending money and then deriving interest. So from a bank account or investing in property, you've got to determine what kind of set of rules cryptocurrency falls under. And most assets, property, shares, as many of you may be aware, are CGT assets, and then they're subject to the capital gains tax regime. If you hold them for more than 12 months, you can potentially get the 50% CGT discount if you're an Australian resident individual or trust, or 33 1/3% if you're a complying super fund. So the usual starting point is, well, are cryptocurrencies, the tokens like Bitcoin, Ethereum, Solana, are they CGT assets? And a CGT asset is defined as any kind of property or a legal or equitable right that is not property. And the ATO has concluded that Bitcoin is property for CGT purposes. So it is subject to the CGT rules. It is a CGT asset. And they kind of say, well, you look at it, you do have kind of certain features of property when you hold Bitcoin. You can exclude others from the right in question, because if it's in your wallet, nobody else can access it unless they've got the private key. You can transfer it. It's recognized as having value in commerce or certainly by third parties. And so the ATO's view, expressed back in 2014, was that Bitcoin is property for CGT purposes. I guess the question then sort of arises, well, that's Bitcoin, but there's thousands of cryptocurrencies out there. Is it every single one of them, are they CGT assets as well? And again, sort of no sort of public guidance has been issued by the ATO on this, but certainly in a number of private rulings, the ATO has concluded that other tokens are CGT assets. So in one private ruling, there's a self-managed super fund that acquires Bitcoin. It transfers the Bitcoin to kind of the trustee, admittedly in contravention of the self-managed super fund regulations. And that trustee uses the Bitcoin to acquire Engine and another coin, ZRX. And again, going through the kind of the same principles in the ATO's ruling on Bitcoin, that you can exclude others, you can transfer it, that these tokens are recognized as having value. Then they concluded that Bitcoin, Engine, and ZRX are CGT assets. So it seems that the ATO is extending its view that Bitcoin is a CGT asset to other tokens, and I'd expect that they would take that view more generally in relation to all types of tokens. So I guess if you take a step back from that, it kind of means that, yes, cryptocurrency is a CGT asset, and I guess within the traditional framework of our tax laws as we understand them, cryptocurrency does fit within the CGT rules. And there's another ruling here, without going into the facts, they took the view that Ethereum tokens are also CGT assets. So there is some precedent, although admittedly not binding on taxpayers generally, that other types of tokens other than Bitcoin are CGT assets. And I guess when you then look at the CGT rules, there's a whole range of exceptions. And I know there was one question on the CGT treatment of tokens and various exceptions from taxation to capital gains. So hopefully this section will answer that particular question. So one issue is capital gains from what we call personal use assets are disregarded if the cost of those assets is $10,000 or less. So sort of cars and yachts and that kind of thing. And all capital losses from such assets are disregarded. Now, personal use asset is one that's kept or used mainly for personal use or consumption, so boats, white goods, furniture. It's not possible for an asset to be a personal use asset if it was acquired for investment or as part of carrying on a business. So the question that frequently arises is, well, is cryptocurrency a personal use asset? And the ATO's view is that, yes, it can be, if you acquire that cryptocurrency and within a short period of time, you use it to acquire items for personal use. So let's just say you exchange $500 of AUD for a particular token like Ripple. And a couple of days later, you use those Ripple tokens to purchase tickets to a concert, right? So in that case, the tokens you acquired would be a personal use asset. Less likely to be a personal use asset if you need to then exchange it for another type of cryptocurrency to purchase items for personal use or consumption. And the ATO view also is that the longer you hold cryptocurrency, the less likely it is that it will satisfy the requirements to be a personal use asset.
So it's more likely to be in, for example, a hot wallet where it's spending money for like coffees, tickets.
That's right. That's right.
And you do keep that balance sort of moving.
Yep.
Yeah. Okay.
That's correct. There's also another type of asset, collectibles, which is treated sort of uniquely under the CGT rules. So capital losses from collectibles can only be offset against capital gains from collectibles, and then collectibles acquired for $500 or less are exempt. And a collectible is artwork, jewelry, an antique coin or a medallion, rare folio or manuscript or book, postage stamp or first day cover. And I suppose when you kind of think about cryptocurrency, you wouldn't expect it to fall within any of those. It's not really a coin, even though it might be described as such. An interesting one is where you've got sort of an NFT, a non-fungible token, that gives you the right to digital art, and whether that would fall within kind of this concept of artwork. And certainly it's only been considered, again, no public ruling, but in a private ruling, the ATO view seemed to be that a non-fungible token which represents digital art is not a collectible. So artwork's defined as a painting, sculpture, drawing, engraving, a photograph, reproduction of such a thing, or property of a similar description or use. So the ATO view seems to be that an NFT, even though it might give a right to particular digital art, doesn't kind of fall within property of a similar description or use.
So, Julian, that would exclude gaming NFTs, I suppose. Have there been any arguments that gaming NFTs could meet the private use asset description?
Yeah, I think they could potentially constitute personal use assets where you acquire an NFT that kind of represents your avatar in an online game. I don't think the ATO specifically considered it, but that certainly would be my view. And I've thought about that. Yeah, that's some NFTs or tokens that give you a right to a particular character in a game or for use in a game could satisfy that personal use asset definition.
Right. Thank you.
Yeah. So yeah, just further to the last slide, this example here involved kind of a taxpayer who purchased 8 different NFTs each for less than $10,000. They were images of unique landscapes. This digital art was collected for personal enjoyment, and they were acquired for the visual aesthetic. Nothing was done with those NFTs except to look at them online occasionally, and they were disposed of for capital gains. So as I stated before, the ATO view is that kind of these NFTs representing artwork are not considered to be collectibles. But in this case, the ATO took the view that they were personal use assets. So they weren't collectibles, they were personal use assets. And as a result, the capital gains from the disposal of the NFTs as they were acquired for less than $10,000 each could be disregarded.
Interesting.
So in addition to being or considering whether or not cryptocurrency is a capital gains tax asset and potentially subject to the CGT rules, you also need to consider if gains from trading cryptocurrency are on revenue account. So I guess just like any business that might trade, I don't know, shares, I guess to take an example of a share trader, someone who frequently buys and sells shares with a view to making a profit. Those shares are CGT assets, but you typically don't get the CGT discount because any gains or losses you make are ordinary income or allowable deductions. The same analysis needs to be conducted in respect of someone who invests or trades cryptocurrency. Even though cryptocurrency is a CGT asset, if your activities are more akin to those of a trader, then any gains you make from trading that cryptocurrency will be accessible as ordinary income, and you wouldn't be able to access the 50% capital gains tax discount even if you held a particular token for more than 12 months. So the key question here is whether someone's carrying on a business of crypto trading. And the ATO guidance in TR 9711, sort of you look at factors like, is there a profit-making and commercial purpose? Is there an intention to engage in business? Is there a prospect of making a profit? What's the size and scale of the activities? Is there any repetition and regularity? Are the activities carried on in a systematic and organized way? So do you have a business plan? Do you keep records? That kind of thing. So that case X86 was to do with share trading, but you can kind of see similar sort of factors to determine if someone's a share trader. You know, do you have an office? Do you operate to a plan? Do you set budgets? So this is pretty critical in terms of working out whether you're entitled to the 50% CGT discount or the personal use exemption for tokens, which is CGT assets, because this ordinary income treatment, if you're carrying on a business of cryptocurrency trading, will override the CGT treatment. So last year, when I sort of gave a similar presentation in November, it was all about gains made from cryptocurrency and whether you could claim the 50% discount. And sort of more of the queries lately have been, well, you know, can I deduct my losses, right? Or are they capital losses, which, as you may be aware, can only be offset against capital gains? So sort of in the context of this crypto winter, I thought it was prudent to go through the treatment of revenue losses. And I think it's important to note at the outset that revenue losses from trading in cryptocurrency will not automatically be deductible. So even if you're comfortable saying that you're carrying on a business of trading cryptocurrency, losses you make aren't always deductible. If you're an individual, you've got these rules called the non-commercial loss rules. And essentially losses from a business activity can be deferred unless your taxable income is less than $250,000 for that year and you satisfy one of 4 tests. And those 4 tests are either the assessable income test, so your assessable income from trading the cryptocurrency for that year is at least 20,000. The profits test for at least 3 of the past 5 income years, your assessable income from trading cryptocurrency exceeded the deductions from the activity. The real property test, that the sort of the market value of property used in carrying on the cryptocurrency trading activity is at least 500,000. Or the final test is the total values of assets used in carrying on the activity is at least 100,000. So, and that might be the case, like some of the software, some of the equipment required to kind of proof of stake, to validate token transactions could exceed 100,000. So I guess that if you're an individual, your client's an individual, don't assume that even though they're carrying on a business of trading cryptocurrency, that they can deduct those losses. You do need to carefully go through these non-commercial loss rules.
On the 4th test, is there a point of time test for that $100,000 threshold? Would that be at 30th of June? The value?
Yeah, it sort of says on a continuing basis. So I'd probably say that
it's fluctuating.
Yeah, I mean, it's interesting because I guess some of that could depreciate.
Yeah.
So yeah, I'm not sure what I can take that question.
Value or
yeah, I can take that
cost value.
I can take that question on board and just revert on that following the session, Electra. Yeah. And then the commissioner's got a discretion, but he'd only ever to disregard a deferral of losses under this provision, but he only exercises that in very limited circumstances. So just something to keep in mind there. And the ATO has issued various private rulings on kind of the non-commercial loss rules. So this example here involved a taxpayer. He was in full-time employment. He was day trading cryptocurrency. Not sure how he managed both, but his taxable income was less than 250,000 per annum, and he derived 30,000 of assessable income from trading crypto for the year ended 30 of June 2022, but made losses of 55,000 during that year. And so there's sort of the ATO concluded he was carrying on a business on the facts, and the losses were deductible. So the non-commercial loss rules didn't apply here because the taxpayer's taxable income for that year was less than 250,000, and he satisfied one of the 4 tests, the assessable income test, requiring more than $20,000 of assessable income to be derived from during the year of income from that activity.
But we're dealing just with traders here, this carrying on a business test.
That's right.
Applied to traders. Have there been, people are using crypto in business more, would they be setting up companies?
Yeah, that's absolutely right. So it's important to note that these non-commercial loss rules only apply to individuals. So Australian resident individuals or individuals carrying on business through a partnership. Now, if you've used another vehicle to trade cryptocurrency, then the non-commercial loss rules don't apply. Having said that, there are other loss recoupment rules. So, for example, for trust, you've got the trust loss rules, like the 50% stake test, the income injection test. So there's other rules that need to be satisfied in order to carry forward and recoup losses from your trading activity. And with a company, you've got the kind of the continuity of ownership test, which requires majority underlying ownership to be maintained in the company, or must satisfy the same or similar business test. So good point, Electra. The non-commercial loss rules only apply to individuals, but there are other loss recoupment rules relevant to other vehicles. Yeah,
we've probably seen a few clients setting up companies when they're seriously into it or want to actually use crypto in the ordinary course of their business.
Yeah.
Yeah.
So, and this slide here just goes through a few different fact scenarios to kind of, I guess, give you a flavour of when somebody might be holding their cryptocurrency on capital account and therefore might get the CGT discount for any gains, but on the flip side only gets capital losses, which can only from disposing of cryptocurrency, which can only be offset against capital gains. So in the first example, let's say a taxpayer purchased crypto to hold for several years, no system, plan or strategy for investment decisions, no trading activity except for one disposal. That would likely hold their crypto on capital account, so not on revenue account. The second example, a small number of trades each year, majority of transactions at the peak of cryptocurrency values, no regularity, routine or system, no written business plan. And again, this is probably more akin to investing in crypto. So you're looking at the capital gains tax rules, not the ordinary income and trading rules. The third one is someone who might be carrying on an activity of mining cryptocurrencies. So they invest in the relevant computer equipment and software. They intend to sell mine tokens to pay off the cost of the mining equipment, and they target a certain income from mining per year. Got a business plan, they set budgets and targets. You can kind of see that this person's gone over, approached it in a much more systematic way. There's a bit more investment involved. So it's likely they'd be carrying on a business. So outside of the CGT rules. And the fourth one is, again, someone who's got a portfolio consisting of several different tokens on different exchanges, daily transactions with significant turnover, 40 to 60 hours per week on research, use of analytics software. And you can kind of see that has more of that business trading flavor as well. So it really does come to down to an analysis of looking at the various facts having regard to the ATO's ruling I went earlier and some of the principles in case law. One area that the ATO was particularly concerned with, especially in the lead up to 30 of June, was wash sales. And this kind of guidance has been around in the context of shares and other assets since 2008. So what the ATO doesn't like is if you're sitting, say, on a portfolio of cryptocurrencies, you might have an unrealized loss of, say, 100,000 hypothetically, and just before 30 of June, you sell all of those tokens, you realize the $100,000 loss, and then you reacquire them. And so the ATO is sort of saying, well, the only reason you've done that is to crystallize that loss. You haven't really changed your economic exposure because you're still holding the same tokens because you reacquired them. And then that loss is then available to offset against other income of that taxpayer. So that kind of wash sale to artificially increase losses, typically before year end, is viewed by the ATO as a form of tax avoidance. And it doesn't need to be the same person selling and reacquiring those tokens. Another scenario might be where the taxpayer sells their tokens that are lost to a related party, right? So, and then that ruling, the ATO's ruling applies both to revenue and capital losses. So just be mindful that, there normally has to be a commercial reason for selling your tokens, particularly where it's going to crystallize a loss. You might be rebalancing your portfolio or something along those lines. So sort of coming back to the CGT rules, what are, I guess, your typical taxing points? And CGT event A1 happens when there's a change in ownership. And the ATO guidance is that this CGT event, this taxing point, happens if you sell a crypto asset, if you gift cryptocurrency, if you trade, exchange or swap cryptocurrency for another cryptocurrency, if you convert cryptocurrency to Australian or foreign currency, or if you buy goods or services. So pretty much any transaction involving a disposal or an exchange of the cryptocurrency asset will trigger a taxing point. And I suppose one of the recommendations out of the Senate committee was, well, the CGT rule should be amended so digital asset transactions only create a CGT event when they genuinely result in a clearly definable capital gain or loss. And I guess, well, when is that the case? Is it if you exchange crypto for another crypto? Can you argue it's not clearly definable just because of the volatility of some of these tokens? Well, there hasn't been any guidance on that particular recommendation at this point. So to go through a very simple example, if an individual invests 10,000 in Bitcoin, after 6 months, if they dispose of Bitcoin for Ethereum and Bitcoin's worth 13,000 at that time, that gain of 3,000 needs to be recognized in your tax return as a capital gain. If after 12 months, the Ethereum's disposed of for Solana and Ethereum's gone down to 8,000 at that point, then there's a capital loss of 6,000 at that time. And then the Solana is converted to AUD after 4 months for $11,000 of AUD, then there's a gain of 3,000 at that time. So you can kind of see that it can be quite compliance intensive, where you've got a number of cryptocurrency transactions in a year of income. If you're buying goods and services, if you're swapping crypto assets for other crypto assets, to keep track of all of the different gains and losses could be quite a compliance intensive exercise. But sort of unfortunately, that's what the ATO requires at the moment. And there's no shortage, I guess, of providers of software now who kind of say this software will help you keep track of your particular cryptocurrency transactions. The alternative is you've really got to download the records of those transactions from your exchange and plug them into Excel and calculate everything yourself. Moving on, do the foreign exchange rules apply to cryptocurrency? And this is an interesting one because gains on foreign currency are generally accessible, and losses on foreign exchange losses are typically deductible. So, and that's under Division 775 and the TOFA rules as well. And the ATO back in 2014 said foreign currency, Bitcoin is not foreign currency because it needed to be adopted by the laws of any sovereign state as the means for discharging monetary obligations for all transactions and payments in a sovereign state. And that obviously that ruling was issued before El Salvador adopted Bitcoin as legal tender alongside the USD. And the ATO hasn't updated that ruling, but in a response to the question on their forum, the ATO said, we're aware of El Salvador's move to make Bitcoin legal tender. The ATO considers Bitcoin to be a CGT asset and not a foreign currency. So the ATO are kind of remaining sort of wedded to their view that Bitcoin's not within the foreign currency rules. And furthermore, in June, the government's going to amend the legislation to clarify that crypto assets will not be regarded as foreign currencies for tax purposes. So you're basically in the framework of you're either in the CGT rules where you're kind of investing in crypto but not trading it, and then if you're trading it, then you've kind of got to look at whether the gains from crypto are ordinary income and the losses are allowable deductions.
Notwithstanding that many businesses are using Bitcoin and crypto assets as currency, like money, it's an accounting challenge first, then a tax challenge. So yeah. Okay, this is what I'm very interested in, Julian. We're struggling with structuring.
So structuring, I've kind of grouped it into two elements. I mean, you've got sort of your founders of projects who issue tokens and for various reasons, and you've also got a subset of I guess service providers who are companies that kind of provide services to the crypto space. So there might be suppliers of, for example, of mining equipment or equipment to facilitate staking, but the service providers don't necessarily, I guess, raise funds using crypto or trade in crypto. They're more providing a service to operators of projects in the crypto industry. So there's been, I guess, quite a few clients operating in that space, and you know, some of them also sort of provide solutions to businesses that not necessarily that might facilitate the use of crypto in transactions. So one example might be a foreign group who provides software to facilitate businesses accepting cryptocurrency as a form of payment from their customers. So kind of using crypto as a payment solution for customers is quite a big focus by a number of businesses around the world. And there are a number of providers of software, sort of payment solutions, software, where they're seeking to expand in the Australian market. So this example here might involve a foreign company. There might be customers in country D, customers in Australia, and the customers in Australia would be businesses who are looking to have this software implemented that allows them to accept payments or make payments in cryptocurrency. So the issues here are, I guess, more generic for any type of corporate group. You've kind of got transfer pricing depending on where IP and customer support services are provided from around the world. you've kind of got this question of whether the Australian OzCo is in a significant global entity, in which case it's got additional reporting requirements, where the accounting consolidated group has global turnover of Australian 1 billion or more. There might be withholding tax on in Australia on payment of royalties to 4Sub in country A who has the IP. Permanent establishment risk if OzCo Proprietary Limited has employees or agents in other countries. So, I mean, this is your typical corporate structure where the group isn't necessarily trading cryptocurrency as such, but it's providing more of a solution to businesses who might be using cryptocurrency to transact or allow their customers to transact in cryptocurrency.
Similarly, for payments within their group. So would transfer pricing come into this as well?
Well, yeah, normally these groups, and it could be that they transact in cryptocurrency within the group, but more often than not, I think they trade fiat, and normally they're just providing a solution to someone in that crypto space. So not necessarily, cryptocurrency may not necessarily be a focus, but if there was a transaction, a provision of goods and services between foreign entities in Australia and payment for that was in cryptocurrency, I imagine your ordinary transfer pricing rules would still apply, notwithstanding that the payments in crypto rather than.
Look forward to hearing how that goes.
Yeah, that's true, and you may well have gains or losses on the disposal of that crypto, because if you've been holding it on for some time as an asset in its own right, and then you use that to pay for goods or services, any gain or loss, any movement in the value of that crypto from the time you acquire it will be a gain or loss at that point. So that would be another layer which you wouldn't typically see in the context of a payment using AUD, for example.
And so,
yeah, this is an Australian-owned group, and then might have foreign subsidiaries. And it carries on a business of developing, publishing and distributing mobile games and digital entertainment content. And it releases a blockchain-powered game based on Ethereum. It's got tax losses of 2021. And it recently acquired the shares in a Malaysian company which develops games focusing on the metaverse. And again, you know, this isn't a group that's necessarily raising funds using tokens. It's probably funded in a very traditional form by subscriptions for shares and loans from banks. But it's developing software which is to be used in kind of that Web3, that crypto space. And again, it's the usual rules around transfer pricing, because it's Australian owned as well, the CFC rules. You've got to look at the availability of losses, how profits will be taxed when they're repatriated from foreign subs to Australia, and then from Exco Limited as the Australian parent to the shareholders. So again, I think it's a very conventional structure for groups that don't necessarily aren't necessarily issuing tokens or involved in a particularly crypto project, but are somehow servicing or providing some type of service to the crypto ecosystem.
We might go a little bit over time, but don't worry, everyone, you'll get a recording. So if you do need to leave, before you go though, if you do have any questions, you can ask them in the chat box, and we'll make sure they're answered in the recording, or we'll follow up with them afterwards.
So I guess in terms of the project founders themselves, like the ones who sort of identify a particular crypto project and they want to issue tokens and eventually move to a DAO, what are we seeing in practice? And this is where the lack of regulation, or because it's a very new space, there's been a bit of uncertainty as to how to set up from the outset. So very often you might have the founders of a project who simply raise tokens through a multi-signatory digital wallet. The issue there is that there's still real world transactions like the leasing of office premises where they might need to also set up a company to enable contracts to be entered into, for example, a lease of premises out of which they're going to operate from. So that's sort of not uncommon as an initial starting point. And then some projects may also commence within an Australian company, just because that's typically what we've seen in practice. If you're starting a business, if you're starting a project, then you normally set up in an Australian company, and then you might raise tokens through kind of a wallet held by that company. And this can then present issues when you want to transition to a DAO down the track, because the tokens are in a company, and if those tokens are then transferred to the DAO, then that could trigger a taxing point for the Australian company. Now, we've also seen a number of projects set up in foreign companies. So it's kind of a commonly used legal structure might be a foundation company in the Cayman Islands, which are ownerless and with a separate legal personality. And they're frequently set up in conjunction with DAOs. But I think the issue, at least for Australian founders, is that some of these foreign companies are likely to be Australian tax residents. So you're not necessarily escaping the Australian tax framework simply by setting up a company in an offshore jurisdiction. And then the DAOs, they're quite interesting, and I'll be going through those in a bit more detail. They've currently got no recognised legal form, which raises a whole range of tax issues, which I'll cover off shortly. So I guess in terms of structuring, I mean, it's a bit up in the air, especially since most projects eventually want to move to a DAO, and the regulation around DAOs has not really been formalised at all, and it's currently under consultation. But we think that there is a basis for a position to be taken on how DAOs are treated for tax purposes, which I'll cover off shortly.
Just to throw into that mix very briefly, Julian, the Digital Playhouse Foundation is an Australian PBI charity. We thought that would be the best basis for our projects. There's no perfect, but having the DGR status and as a public company, we
yeah, and I mean, charity status is something we have looked at for some, but it very much depends on the project. I mean, you obviously have to have that relevant charitable purpose to get that characterization.
Which was difficult, but yeah, for a philanthropic educational DAO, we thought I think you can get there. Yeah,
that's right. I mean, there's other DAOs promoting things like artwork and music, where I think it's a bit of a harder ask to get that kind of DGR and charitable status.
I was going to talk a little bit about it today, but we won't have time. I'll do another session on the area of philanthropy, so we might chat about that later. Yep. So
in terms of raising capital, and I think there was another question on this, the token raises may be accessible. I mean, there might be an argument that a security token means that it shouldn't be ordinary income, but in any event, there's CGT events that could treat kind of the proceeds received for the creation of a right, like a token, to be capital gains in any event. So I think that's probably the key point to take away, that at the moment, projects raising capital, whether it's in an individual's name, a company's name, possibly a DAO's name, could be accessible income. And again, that could result in taxation in Australia at marginal tax rates. Now, as I mentioned earlier, offshore vehicles can be used to raise funds, but the key issue there is tax residency. Australian residents obviously tax on income from worldwide sources, and foreign residents are only tax on income from Australian sources. But if the founders of a particular project are based in Australia, and if it's an offshore company, there's a risk that the company could be an Australian resident because its central management and control is in Australia in any event. And even if the proceeds from a token raise aren't ordinary income, there's certain CGT events where you can create contractual rights or legal or equitable rights in other entities that can treat the proceeds from a token issuance as being accessible. Now, an interesting one, in addition to kind of getting charitable status, is mutuality. And we often see this in kind of with clubs, whereby you essentially can't derive income from yourself. So if members of a club provide a membership fee, that club won't be taxed on that membership fee, because you can't derive gain or income from dealings with yourself. And there's a whole range of factors relevant to determining whether an organisation's mutual needs to be carried on for the benefit of its members collectively. There needs to be a common purpose. The members need to have ownership and control of the common fund. And, you know, obviously it hasn't been applied in the context of crypto projects, but, you know, the right project might allow for the principle of mutuality to apply. in which case you kind of say, well, if the members of a DAO are essentially subscribing for tokens, then there might be an argument to say that the funds raised from the issuance of those tokens is exempt from income tax based on the concept of mutuality. Now, I stress this is kind of untried, untested. We haven't really seen the ATO apply this view in that context, but certainly it's something that I know that we have considered for some projects. Now, there's different ways that projects can raise capital. There's kind of token warrants where there's the right but no obligation to purchase future tokens. There's a simple agreement for future tokens, which is sort of a contractual agreement pursuant to which investors inject cash into a venture to fund the venture. Or there's a token sale agreement where the tokens are already issued and you essentially sell those tokens in exchange for funds. And as I said, there's a risk that kind of all of the funds raised under each of those methods are accessible as ordinary income or pursuant to various CGT events as kind of summarized below at the bottom of this slide. Now, I did sort of mention earlier that some founders of projects here in Australia have gone offshore, but the issue there with a foreign company is it can be a resident if it's central management and control is in Australia. So the current residency test is if a foreign incorporated company carries on business in Australia and either its CMAC is in Australia or its voting power is controlled by Australian resident shareholders. Now, there are some proposed changes to tax residency, which I'll cover off shortly. So moving on to DAOs, I mean, this whole concept about a DAO, which currently has no legal form. Essentially, you've got community members collectively making decisions about a project, tokens issued to raise funds for the DAO's treasury, which can have voting rights. DAO has no central authority and is governed by the community members, and the rules of the DAO are contained in smart contracts, which are fully visible to everyone. And a lot of projects want to move to kind of this decentralized format. And the question then arises, well, how are these treated for tax purposes? Are they partnerships as a starting point? So for tax purposes, are partnerships an association and persons carrying on business as partners or in receipt of ordinary income or statutory income jointly? So you've got to look, do the tokens carry a right to income? Is there a genuine intention to act as partners? There's no partnership agreement, obviously, for a lot of these DAOs. So I think there's probably good arguments, depending on the DAO, to say that it's not a partnership. And certainly that's been the position taken in other jurisdictions as sort of the extract from the Security and Exchange Commission guidance at the bottom of this slide. I probably think that the more likely position based on Australia's tax laws is that a DAO is a company, because a company is defined as a body corporate or any other incorporated association or body of persons. And so the question then becomes, if a DAO is a company, where is it resident? Is it an Australian tax resident company, in which case it would be taxed at 30% on kind of proceeds raised from these tokens, subject to applying mutuality? Or is it a non-resident, in which case it only pays tax on Australian sourced income? And there's other practical issues, like even if you kind of say a DAO is a company, how practically would it register for an ABN, TFN or for GST? It doesn't have any kind of legal form as such, or appoint a public officer. And I think there's an interesting thing to be said about a DAO where it's truly decentralized. I'm wondering if there's an argument that it's not a resident of Australia. Can you really say that a DAO's central management and control is in any particular jurisdiction? Because the whole theory behind a DAO is that its control is vested in the members, and they could be anywhere. In fact, there may not be any visibility on where the members of a DAO are resident or where they're based. They could be in any number of sort of countries around the world. And an interesting one there is what control the founders continue to have. So if the founders of a project are in Australia and they set up a DAO, is it truly decentralized in the sense that do the founders have an ability to override decisions of the DAO, and what role they continue to play in the governance committee going forward? So a number of issues, interesting issues to work through with DAOs, how they're taxed, how they're treated for tax purposes, and if they're companies, where they're resident. And so this slide here really just goes through kind of the tax residency principles I just spoke about, and some changes to the potential residency rules for companies going forward. DeFi is sort of another interesting one, where you kind of have sort of a DeFi lending platform where lenders deposit fiat into that platform, that's converted into sort of stable coin loans to borrowers, who then pay back the interest in the form of stable coins, and that then goes back to the lenders. And there's typically quite high collateral provided by the borrowers under this type of framework. And I guess if you think about sort of a traditional funds management model, where kind of investors come into a debt fund, which is typically a unit trust here, and that unit trust then lends out to various borrowers, the risk is that that unit trust may be taxed as a company. So essentially, under Australia's tax laws, if you've got investors who might subscribe for fiat in a unit trust, which then makes these cryptocurrency loans to various borrowers, if there are more than 50 investors and the unit trust carries on non-eligible investment activities, then the unit trust will be taxed as a company, won't be treated as a flow-through. So the issue there is, if a unit trust holds cryptocurrency, is it eligible investment business? It's not kind of a secured or unsecured loan. Is it a bond or debenture? Is it shares in a company? So I think there's a risk where a unit trust holds cryptocurrency, that it might be taxed as a company where there are more than 50 unit holders. But that's sort of one of the DeFi structures that we've seen in practice. So moving on, another issue that we're starting to see more frequently is how to remunerate employees in kind of this cryptocurrency space. And it's starting to sort of be like, you've got employee share schemes and employee option schemes. And some of the thinking around these projects is, well, why can't we remunerate employees with tokens? And the ATO took the view, again, back in 2014, that Bitcoin is property for tax purposes. So if it is provided in respect of employment to an employee, it would be treated as the provision of a fringe benefit, and fringe benefits tax would then be payable by the employer on the provision of that token. So I suspect that the ATO would be extending this view to other tokens as well, not just Bitcoin. So I guess, what are your options then if you want to somehow provide tokens to your employees? Can you pay a bonus to employees to allow them to invest in tokens? Yes, the issue there is that the bonus would be taxed first as salary and wages at the employees' marginal tax rates, and then they're really only able to invest that net amount in tokens. Are options over tokens feasible? This could require the employer to hold an AFSL, Australian Financial Services License, as the options may be considered financial products. Or another option might be to look at some type of loan-funded token plan. So instead of giving the token to the employee for free, can you look at something like a loan-funded share and option plan and have a loan-funded token plan, whereby you make a limited recourse loan to employees, allowing them to subscribe for or acquire tokens from the employer. And I guess that raises some interesting issues. You've obviously got the provision of tokens, as I said, is a fringe benefit, but where it's loan funded, the employers are paying market value consideration, so the taxable value should be nil. Then you've got sort of the provision of the loans, and if that's interest free, would that be a loan fringe benefit? You've got the otherwise deductible rule that typically applies to loan fringe benefits used to fund, say, an acquisition of shares under a loan funded share plan. But the issue with tokens is that some tokens might not generate any income. There might be a question as to, can this token be staked to derive income? Otherwise, the provision of the loan could be a fringe benefit as well. And there's other issues. If it's a private company and the employee's a shareholder, you've got to kind of look at Division 7A as well. So the whole range of issues with token funded, remunerating employees by way of tokens. And here, I mean, there's just a question as to whether contributors are employees to a particular DAO. And I think there is a risk that the contributors will be employees, just based on some of the advertisements I've seen for contributors out there.
Julian, I know we've gone a little over time, but just on the topic of contributors, those are the members of a DAO, right, who are contributing.
That's right.
In some form.
So
what
where you might go out, yeah. And it's not uncommon for contributors to be, I guess, provided with tokens for the contributions they make, which then raises the question of, well, if they're employees, does the DAO, is it technically liable for FBT in respect to the provision of tokens to contributors? So there's a whole range of issues in relation to DAOs that will hopefully be resolved through the kind of current consultation process. Going beyond tax, employment law issues as well. Like, is a contributor entitled to annual leave or long service leave entitlements?
It's going to be clarified once we decide whether that master-servant relationship exists, because really a DAO is just a software, smart contract-driven machine of individuals and freelancers, in my mind. So yeah, once we get clear on what a DAO is, if it is an actual entity, and as you mentioned earlier, that could depend on at which point it has become decentralized, how centralized it is. Because there's no sort of DAO first organizations that I've really come across that can start out purely decentralized. The founders control it in the beginning. They must.
Well, that's what I mean. And the founders typically have an ongoing role to play in the governance committee, even though some of the membership might change. Usually the white paper or the underlying documentation usually provides for the founders to have an override. So I query whether some of those DAOs truly are completely decentralized at the moment.
Yeah. Fantastic.
So kind of this is coming back to that initial question on theft and loss and scams and that kind of thing, and what happens there. I mean, we've probably all read about the guy who threw away one of the hard drives in his desk drawer a few years ago, and apparently one of them had the private keys to $79 million worth of Bitcoin. Can you claim a loss in that type of scenario? And sort of the ATO thinking is that you can, if you forget a password to a cryptocurrency wallet or you lose it, then you can claim a loss, but they are going to require certain evidence: the date you acquired the private key, when you lost it, the digital wallet address, the cost to acquire the assets in the digital wallet, and so on and so forth. So there's a kind of a range of evidentiary requirements to claim a loss in respect of where you've lost the password to access your particular digital wallet. And then there's kind of all the other types of losses around scams and theft. So there's a capital loss that's provided for under CDT event C1 for a CDT asset that is lost or stolen. So you could potentially claim that, where you've lost cryptocurrency due to an exchange going under or investing in a particular scam. Another mechanism might be where you're a trader. If you're trading cryptocurrency, when you preparing your tax return, you need to compare the opening and closing values of your trading stock, and any excess of closing over opening trading stock is assessable. Any kind of excess of opening over closing is deductible, and you can reduce the value of your closing trading stock by the value of any lost items there. There's also another provision, section 25-45, which allows a deduction for a loss in respect of money caused by theft, stealing, embezzlement, larceny, or defalcation or misappropriation by your employee or agent. So that's a particular provision that might give a deduction there. And I guess if you've invested in a scam, you could argue that the contract, if you invest, there's a contract to receive the tokens, but if you never receive the tokens, it's been abandoned by the issuer. CGT event C2 could apply to allow you for a kind of a capital loss in respect of the funds you proceed that you've invested. So there's a range of avenues. Some might not always provide a deduction, but at least you should be able to get a capital loss in a lot of different circumstances where you've lost money due to an exchange going under or because you've invested in a particular scam. Just in brief, I mean, mining rewards, tokens received from mining should be accessible. Tokens received on creating a new block, forging a new block are ordinary income. Airdrops, ATO viewers that tokens are ordinary income when you receive them. And chain splits, even though you might have two cryptocurrencies after the split, the new cryptocurrency isn't accessible but has a nil cost base. So I just thought it was worthwhile mentioning some of those in brief. So yeah, I mean, in closing, as you can see, there's quite a bit to kind of be aware of in the context of crypto and digital assets and taxation of those assets and founders of projects and that kind of thing. And also quite a bit of uncertainty, particularly in relation to the taxation of DAOs. So hopefully we'll get some clarity coming out of the various consultations that are happening at the moment. But on that note, I'm happy to stick around and answer any further questions the audience might have. Any other questions coming through? Okay, Electra, please feel free to reach out. My contact details are here if anything comes to mind post webinar. Thoughts on the Celsius platform? Okay.
Oh yeah, the Celsius question.
Is that kind of the losses under that platform?
That was the CFI platform that so it's not really a crypto, it's not a decentralized, it's not a DeFi, but it's a Celsius platform. It's just like a bank closing down and you're losing your money, really.
Yeah, I would have thought in that case you'd be able to claim a capital loss at least, based on sort of my last few slides there. Yeah.
So what tip, Julian, would you give accountants who are inexperienced with crypto and Web3, but want to be prepared for when it's a matter they're consulted on? So when they're approached by a client who talks about the things you've talked about today, what should they do?
I think the best thing to do would be read. I mean, the ATO guidance on its website is pretty comprehensive, and it does set out a lot of the existing framework. And to be honest, I've covered most of that in today's presentation. But it also covers off on GST as well. So as a starting point, I'd be looking at that guidance and really just staying on top of the border tax consultation, because that's going to be the one that mainly drives the kind of key changes to our tax framework and additional guidance.
I think we've all read the ATO guidance inside out in this group, and we're waiting for the outcomes of the digital asset review. We do have a question here whether, in your view, do you think DAOs could ultimately be treated akin to a company, or whether they may be viewed as a see-through entity, or I would think a flow-through entity like an LLC?
Yeah. I think the proposal at the moment is certainly to treat it as some type of company, following on from what's been done in other jurisdictions. I think Wyoming and one other jurisdiction. So yeah, I don't think the proposal is to treat it as a see-through or look through at the moment.
Okay, we'll wait and see. And also, I mean, the regulators are just seeing what's happening in this space and how these DAOs are being used and for what purpose. So there might not be just one prescriptive set of rules for DAOs. There'll be different types of DAOs and that have different purposes, whether they're making profits, surplus, or whether they're just individual kind of groups of individuals just working together. It remains to be seen. But so people here can contact you if they have a complex.
Yeah, for sure. Yeah, happy to have a chat, or just reach out by email if you've got any other queries. And I'll revert on that question you had, Electra, on kind of the other assets test and the non-commercial loss rules and how you value sort of assets on an ongoing basis or not.
Yeah, it's a curious one. I only just thought of it then, but that could be an issue. Thank you so much, Julian. This was fantastic. Real deep dive. Don't know what you don't know.
Yeah.
today. So, and everyone, thank you for sticking around. You'll get an email by the end of the week with these materials. Thanks, Julian. We'll keep in touch.
Thank you. Thanks all.
Have a great week, everyone. Bye.